Hello, this is Megan Horniman. I'm the Chief Investment Officer at Verdence Capital Advisors, and we're coming to you today to give you a review of 2025 and then offer our themes from both an economic and a market perspective for the 2026. Now, before we get started with that, we always like to start with grading the themes that we offered to you in the beginning of last year. So let's dig right into those. Our first theme on the economy was the economic expansion will continue, but at a slower pace. And that did come to fruition as we saw economic growth that's on pace to be about 2% in 2025. And that's modestly lower than we saw in 2024 when it was 2.8, and then below the average we've seen since COVID, which is 2.9%. Now, when it came to inflation, we said the inflation battle is not over, and that we're going to give ourselves a check mark as well. That's because even though inflation is decelerating from some of those multi-decade highs that we saw, you're still seeing core inflation in the consumer price index that's growing about 2.6% year over year. And then when you look at PCE core, which is the Fed's preferred measure, that's growing 2.8% year over year. And we have had some periods during 2025 where we saw monthly increases a bit more than expected. So it's very difficult to say that inflation battle is completely over. We're not near that 2% level that the Fed's looking for. When it comes to global equities, we actually were wrong on this. We did expect more muted returns last year because the bar was set very high coming into the year, and equities continue to defy all expectations, not only from the earnings perspective, but even with the handful of things that were delivered to us last year, the tariff, Liberation Day, the volatility we saw then, the equity markets still continued to rally. We actually saw the MSCI All-Country World Index, that was up about 22% last year. That's the third consecutive year of double-digit gains. From a fixed income perspective, we thought we'd be higher for longer in interest rates. When we look at that, though, the 10-year yield did fall about 40 basis points in the year, and the 10-year treasuries outperformed short and intermediate bonds. So we weren't quite right on that one. When you look at alternatives, we said it would be a shelter from the expensive public market, and we mentioned things like real assets, specifically on the infrastructure side. And when you look at an S&P Global Infrastructure Fund, that actually outperformed the S&P 500 by about 465 basis points for the year. We also mentioned hedge funds and the volatility we would expect, and we saw that come to fruition. In fact, hedge funds were up about 10%, and that's just through November where we have data. So we're going to give ourselves a check mark on that one.